we've got a lot to chat about. So good morning, guys. How are you?
We're doing well. I mean, it's looking like a slower week, but in terms of what I call tier one economic reports, but I don't think it's a slower week in terms of event risk in general, Corey, because we have, there's a lot of conflicting messages coming out of the market. Obviously the market is still undecided on the whole, debt negotiations, whether it's going to be smooth or not. But more importantly, or equally importantly, we're getting a lot of mixed headlines from the Federal Reserve. And the language that we're getting from Fed Chair Powell and some of the Fed presidents are completely conflicting. And I think when you have that and you don't have uniformity in their views, that's where, there could be volatility in the markets. And that's what we've actually seen throughout this morning, over the weekend. Over the last week, with some hawkish comments from Federal Reserve presidents, led everyone to believe that the 25 was on the table. The dollar did fantastic last week. But then over the weekend, Fed Chair Powell came out and, he basically suggested that they may not, need to raise interest rates any further. I mean, more specifically, he said current banking stress could mean rates may not need to rise as high as otherwise to slow the economy. So everyone started to believe that he was setting the stage up for a pause. So the dollar sold off in Asia, it sold off in Europe. But then again, this morning, you've got Bullard, Kashkari saying, especially Bullard, 2 more rate hikes before they draw a close. So no one knows what they're going to do. And
now Kathy, they've historically been very unified in their opinion. Where do you think this dissension comes from Bullard?
I don't think the Fed is a central bank that's very unified in their opinion. The European Central Bank is very unified in their opinion. And usually the message is very clear. It's always focused in one direction. The Fed is kind of like Washington, right? They're all got their different opinions. They're all sharing their opinions and not sending a clear message to the market. So this is not unusual. But it is important because, everyone thought, they were pretty much done. And when you have someone as influential as Bullard saying that maybe not, and not just saying one, maybe two, that is causing a lot of confusion. And this week we have the FOMC minutes. And because we have all of this uncertainty in regards to what the Fed will do in June, everyone will be really keying into the Fed minutes for additional clues and maybe to use as a guide to set their positions. So while the calendar itself, Corey, has very little in terms of tier one data, I think there's a lot of things that could trigger volatility. We also have the PCE deflator at the end of the week. And for those of you that don't know, the PCE deflator is even more important than the inflation measure for the central bank. And so that could be very market moving too, because, like I said, the Fed's keeping us guessing. So that's just on the U.S. calendar. And that's not even including any headlines that we get out of Washington about the debt ceiling. So, I think it may not be as quiet as everyone anticipates.
Good. A lot of trading opportunities, it sounds like. So what are we watching?
So first, I hope you're watching the YouTube live stream, because I'm going to add that into the link right now, because we will be sharing our charts very shortly. So
nice segue. I like the segue.
Yeah, the YouTube
and you guys could also ask questions in there as well. The YouTube live chat, ask questions. We'll answer those live with Boris and Kathy here.
Yeah, so the tweet is sending. It's going to be out there in a second. And so please go to that. But, we're obviously watching the US dollar. We're watching, you can see from the, Boris was just telling me earlier about how we had that spoof in the headlines that drove stocks down 100 points with the, fake news about, what was it, Boris?
It was an explosion near Pentagon. It was fake news.
So the fake news about the explosion, but it seems like equities have kind of held on to their losses. I mean, I agree there's absolutely no merit to it, but equities are kind of wobbly. And all morning they had been flat and just waiting for, kind of a driver. So I think, everyone should be watching equities. US yields has had a fantastic run recently. Keep an eye out on that. So we've got all the events that we talked about, the US dollar. We also have the Europe. We've got, the PMIs, the IFO report. What's really interesting is this weekend, even though Powell suggested that they could set the stage for pause, ECB President Lagarde came out and said, I don't think, that we can slow down and take the eye off the ball on inflation. And that, in contrast to the Fed, they're going to need to press forward. So I think that's going to be very important to watch, because you've got very consistent message from the ECB about how more needs to be done. But data, on the other hand, has been terrible. And I think the PMIs and the IFO could be weak too. And then we have a rate decision this week. We have a rate decision from the Reserve Bank of New Zealand. And even though it's tiny little Australia and the other side of the world, I think it's important because it's kind of indicative of where central banks are and how they're feeling. So originally the market was thinking 25, but now it's 25 or 50. So the fact that they feel like they could need to plow forward in light of U.S. central bankers, certain ones like Pollard saying we're not done. Maybe the world really isn't done. Maybe inflation is still as sticky in so many parts of the world that they need to, we'll see at least one more from all the major and minor central banks.
Have the Fed funds futures updated today?
Very good question. So I was looking at them earlier this morning. I don't know if they really changed right now, but they actually haven't changed that much. I mean, last week at some point, it was like 40% chance of a quarter point hike in June. But this morning, it was 20 before the Fed funds futures opens. Now we're at 27. So you see that the market's moving a little bit more towards 25, but still basically, 1 in 4 chance of a rate hike in June. So we still have quite some time until then. A lot can change. I believe we also have one more NFP report. We definitely have one more NFP report before that. We have probably one more inflation report. So these Fed fund futures, we talk about them often, Corey, can change all the time. They change day by day.
Very data dependent.
Right, week to week. So keep an eye on them because they're very important. But I would not make too much of today's move.
Yeah, they're not Fed fund futures. They're Fed funds presents. I think, though, however, they have it right for now. Bullard is not a voting member. Bullard is also, I tweeted out, Bullard is like Florida weather. Just wait a minute, he'll change his mind. So he likes to make headlines. I think Chair Powell is the most important person here in terms of setting agenda for the Fed. And I very, very much doubt we're gonna hike unless, as Kathy says, the PCE could be a big number today. I mean, that's a sharp surprise to the upside. That could be kind of a body blow to the market and to the rate bears. Other than that, if you look at true inflation, which is sort of a daily measure of inflation, we're actually crawling all the way down to almost 3%. I mean, prices are falling all across the board. Demand seems to be, I think demand for services is very strong, but demand for goods is definitely weak. I mean, all retail stocks just did. I mean, Foot Locker, Home Depot is perfect example. But then just also other ancillary stuff like Foot Locker, like the whole XLR ETF is really, really underperforming, and that's kind of showing that consumers are really not spending. They're spending money on experiences, but not necessarily spending money on goods. And I think that probably keeps the Fed at bay for the time being, unless you really see some, surprising inflation coming out from somewhere else. So I think, the Fed funds futures, quote unquote, pretty much have it right at this point. But it does create lots of volatility. We also between now and then, we don't know if we go into default. We don't know where where the budget deal goes.
A lot of unknowns.
We don't know if they compromise on something that actually could be, this is one of those things where the cure is worse than the disease, where if they compromise on cutting spending, that effectively almost ensures a recession into the U.S. economy,
I'm glad you brought that up. What's the latest on the debt ceiling talks? More of the same?
It's all the same. They're posturing. As usual, I don't think they're not going to really compromise it. First of all, neither side can really compromise without completely destroying credibility on its own side, right? I mean, Kevin McCarthy especially faces a very, very rabid right-wing bloc that basically doesn't want the government to spend anything. And so if he comes out and says, we're going to do the same spending as we voted on, basically, it's fine. I wonder at this point if President Biden, I mean, it's interesting to me. President Biden people underestimate him. He's always been much more of a maverick than people think. And I'm wondering if at this point he's just fed up and he's just going to invoke the 14th Amendment, which is what he should do. And just, and if he does that, then the whole drama goes away. I mean, we got to go to SCOTUS, but it becomes a different story.
Right.
We're at a point now where I think negotiation in Washington is almost impossible. Like good faith negotiation is almost impossible.
Sure.
We're literally effectively in a civil war. We're in a civil war without firing weapons. So, I doubt the political climate here is going to produce anything meaningful. But
so you think 11th hour, like we get something through at the last minute, or do you think they shut the government down? What are our bets right now?
I think there's 3 scenarios. They do compromise on something and everybody hates it, which is probably like its own definition of compromise. They shut the government down, and then it just becomes a matter of chicken, like who's going to blink first, or Biden just says enough of this nonsense. We're not going to go through this every 2 years. I'm invoking the 14th Amendment. This is bullshit. And this is bull s. We have a really interesting story because then it becomes a sort of a constitutional crisis because then everybody starts screaming, "Oh, you can't do this! You can't do this!"
Right.
There's actually massive body of constitutional law that says the whole debt ceiling idea is utterly nonsense. Because under the 14th Amendment, the Congress, it literally states very, very clearly, Congress must pay all its debts, and this is past that. So you got to understand, this isn't future spending they're arguing about. They're arguing about the budget. They've already passed. This is already law. This is already mandated spending. So you can't go back. It's like saying go back. I already bought the car, but I don't really want to pay you my credit card bill. That's essentially what they're saying. I already purchased,
right.
We agreed on a purchase, but sorry, I don't want to pay it now. I need to go on a budget. I need to go on a budget now. You can't do that, So I think probably that should be the thing because at this point, I think the country is just tired every 2 or 3 years of this nonsense. It's
right.
just it's nonsense.
Well, I think most urgently is what's going to happen if there's going to be any progress this week. And I think we're not going to see much in the way of developments this week. I think they're definitely going to push it through the Memorial Day holiday. I think they're definitely going to push it into the deadline. So what that means in my books is that you're not going to see any meaningful rally in stocks until we get really clear sign that a deal is going to be reached. Equity traders are going to be cautious, and that cautiousness is going to carry over into commodities as well as currencies. I want to show my chart here, which for those of you that are on the YouTube live stream, please go to who's on the Twitter live spaces, please go to the YouTube live stream. I want to share my screen. Just give me 1 second. So here, what I have and what you're seeing is the candlestick is the 10-year US bond yield. And the orange line is gold. So typically, if we go expand out to the chart, this is a daily chart, you can see that 10-year yields and gold basically move in the opposite direction. Like when you have rally in the 10-year yields, you tend to have weakness in gold. When you have rally in 10-year yield here, you have weakness in gold. When you have weakness in 10-year yields, you tend to have rally in gold. And that is consistent with the fact that, the US dollar tends to move in the direction of yields, and the gold is priced in dollars. So what this is telling us is that, based upon this move in US 10-year yields, gold prices should be much lower, but they're not. And gold prices are not falling because, there won't be true uncertainty in the markets until we either get the government shut down again or there's a default. And so gold traders and gold bugs are not necessarily buying into that idea yet and preventing gold from really crashing lower, even though the dollar's stronger, even though yields are stronger. So that's why this correlation, this relationship has broken down. Now, if we look at the Dow, and we've got gold on here as well, we talked about how, the consolidation that we're seeing in equities right now is one of the main reasons why we're seeing consolidation in gold as well. If we look at a longer term chart and correlations, I'm a huge proponent of correlations. I think, they're very, very important. You can see, just bird's eye view that Equities, the Dow, has a very strong positive correlation with gold, which means that when people are optimistic, typically, unless the world's coming to an end, they both tend to move in a similar direction. But I think that right now it is true that the consolidation in stocks is driving the consolidation in gold. So if you believe like I believe, that there's not going to be any breakaway moves in stocks before, definitely not this week, definitely not through the Memorial Day holiday in the US, and we're not going to get any real movement in stocks until the end of the month, closer to the X date of June 1st, then what you can expect is that there's going to be more consolidation in gold prices as well. So gold's been consolidating between 1855 and about I guess about 2020 or so, and that's going to be the range right now. It looks like it may come down towards the bottom of the range, but that range is still the main range that we're watching in gold.
I agree with Kay that consolidation seems to be the order of the day. And one way for traders to measure that is just to look at the absolute range of whatever instrument they're trading. And when it comes to stocks, especially, this is what we're looking at. And you're seeing that the absolute range of the Dow, for example, today, from the absolute low to the absolute high is less than 300 points. That's less than 1%. It's not a very, very volatile day. In the NASDAQ, it's even more constrained. I think it's like 770, it's 130 points. Also, basically about 1%. This is from absolute high to absolute low. What we like is anything above 1%, because I'm not talking about the range during the U.S. hours. I'm talking about the 24-hour global range. That is the overnight futures to this. If you can get those ranges to be 2%, that's when you have a lot of good trading and a lot of good trading opportunities. And anywhere between 1% and 2% width from high to low. And we're not seeing that. It's very, very quiet because, as Kay is saying, everybody's on the sidelines watching.
Kathy, would you pull up the VIX chart so we could take a look at that?
Yeah,
we've looked at that previously.
Let's just shift over to the VIX and let's get rid of this. I mean, gold's on there, but VIX remains very, very low. There's been very little movement in VIX at all. And if investors are truly nervous, VIX would be probably closer to here or in this zone over here. And it's perking up a little bit because obviously as each day passes, the closer you get to the deadline, the more concern there is. But we've been as Boris said earlier, we've been down this path before. We've been down this path often, and I don't think. And you can see from the fact that stocks haven't crashed, the fact that the dollar is holding steady and the VIX is low, and gold is consolidative, that investors are not pricing in a default.
Good to hear. Yeah. So what's the play here? What is tradable in this? What are we looking at this week for a trade?
I was going to actually leave FX to you because I think FX may be tradable. As far as equities and commodities, you're just trading ranges right now. And, I'll be happy to speak to that in a little bit. But, you want to talk a little bit about it?
I mean, we talked about euro dollar. Let me just change this back over to my candlestick charts. We talked about euro dollar. I'm just going to bring in my indicators and how I think that the data is going to be weaker. This is the first time. Last week was the first time that we closed below the 100 SMA in euro dollar since, when was this? Since this period here, November of 2022. So that's significant. I mean, this is certainly, especially with the moving averages so close to each other, this is certainly indicative of trend change in euro. So if you share my view that the Eurozone economy, we're going to see weaker PMIs, we're going to see weaker IFO because other data has been horrendous, and we're not going to, the market's still going to be optimistic dollars, and the Fed's minutes may not be all that dovish, then I think this could still be downside in euro dollar. I think 107 is support in the euro dollar. I also like Kiwi going into RBNZ. Now that's I believe that's Wednesday. Let me just check my calendar real quick. That's the Wednesday New Zealand time, Tuesday night East Coast time. So I'm still bullish Kiwis. So I think there is some opportunity for those of you like crosses. I love to trade crosses. Sorry about all this But I love to trade crosses. I think Euro Kiwi's been in a very strong downtrend. I think it continues to remain in a downtrend. I like Kiwi Swiss as well to the upside. I think we could see it move up to 57.50. So my eye is on Euro, and it's on Kiwi this week. I think that's the opportunity. Now, in terms of the debts ceiling itself, we always look at dollar Swiss, dollar yen, and dollar yen's been very, very strong. And I think that until we get some bad news, it's still a buy and dip.
Got it. And Kathy, before we leave FX, can you share with us your heat map for the week?
Certainly. My heat map is over here. Let me share this tab. Okay, so in terms of the heat map, I am just kind of general and neutral bullish dollars, and the reason is because the conflicting news that we have from the Fed, as well as the uncertainty with the debt ceiling. I don't think we're getting, and we don't have much data, so we're not really going to get that much traction in the greenback. I'm bearish euros. We talked through that, and we talked about how I'm bearish Eurozone data. Sterling is very interesting. Pounds. We have a lot of UK data this week. We actually have a lot of tier 1 data. We have the inflation report. We have the PMI reports. We have the retail sales reports. And actually, I think most of those could end up being weaker. And so I don't like trading pound that much because it's very volatile. But I do think the risk is to the downside for the British pound. I'm also bearish Aussies, and the reason is because last week we had horrendous employment numbers. Also, China seems to be intensifying its chip war with the U.S., which investors aren't all that enthused about and not pleased about. So they're, kind of expressing that through Aussie. And, in addition to that, I think we're going to get a little bit more ongoing risk aversion or risk, uncertainty. So that's also going to be bearish Aussies. I'm bullish CAD. We had very good CAD inflation data last week. The data in general, employment numbers, the labor market's hot, inflation's hot. I think, that the oil prices are relatively stable, and they're actually, a bit higher today. So all of that should be positive for CAD. I'm bullish Kiwi because, the Reserve Bank is going to be raising interest rates this week. So, we talked about this earlier, but for those of you that are joining us late, the Reserve Bank came out with a much larger budget. Sorry, the New Zealand government came out with a much larger budget deficit overnight. And so because they have a larger budget deficit, that is indicative of more spending. So they spend more to support the economy. People believe that that's going to keep inflation elevated. And that's why 50 is still on the table. Or 25 with hawkishness and leave the door open for another 25. So I am bullish Kiwis. I'm also bullish Swiss franc. The Swissy has been doing very, very well. And then, selling yen has been a really good trade because the BOJ has been very, very dovish. And we've got Japanese inflation data this week, which I don't think is really going to show much either. But at the end of the day, Corey, it's really about the Fed minutes, the debt ceiling headlines, and just how the market feels about, what's going to transpire in Washington, and also, watching those Fed headlines. I think that's really going to drive the trade in the entire market. I don't know how that looks for you, Boris, in equities and.
Well, let's take a look at equities because I'm going to share the screen, Kay. Okay, I'm going to take my screen.
Hey guys, just so you know, everybody who auditions with a SurgeTrader account does get 30-day free trial to BK Forex, and you do get access to Kathy's heat map as well. So very valuable trading tool.
Yeah, for sure. So what I was going to say is, one interesting thing is sometimes you can actually get some long-term perspective out of a 1-minute chart, because you sort of see on a micro level the critical flows that are happening. And what's happening now, as far as equities go, is that NASDAQ is getting the flows versus the US 30. Now, NASDAQ gets the flows whenever the market, I think, feels that money is cheap. Basically, NASDAQ rallies if interest rates stay stationary or go down, because it's all technology. Technology is highly dependent on higher price earnings yields, right? Technology doesn't need cash. It doesn't need to borrow cash. But if something, it's sort of a competitor. If you think about this, if you're getting 5% on treasuries, you really have to out earn in terms of earnings to be able to truly be a competitive security on the NASDAQ side. On the other hand, if that's all you're going to get on treasuries. It's not going to go any higher, and Nasdaq continues to earn money. Then it becomes a more interesting trade. So you see a huge divergence between Nasdaq and Dow, where the Dow is much more rate sensitive. Those are all capital intensive businesses. They got to borrow money all the time in order to sort of roll their production. I mean, General Motors has to borrow money all the time in order to make cars. Microsoft doesn't have to borrow money ever because they don't have any capital expenditures. They just have a bunch of coders who make stuff up. Same thing with Facebook and everything else. So what you see is kind of an outperformance of tech versus Dow, which is sort of a trade or a bet on interest rates staying stationary, going going lower even. And I think you can see that even on a micro level here, as Nasdaq is like pretty much near the day's highs, whereas the Dow is barely trying to crawl above the midpoint level, right? And so sometimes you can just sort of use the two indices to try to figure out where the overall flows in the markets are. And I thought it was interesting. But overall, when you are looking at markets today, it's really a very range-bound trade. This is what I was talking about in terms of non-interest in the market. The high is what 530, low is 220. It's basically a 300-point high to low move, which is 1% of the day. If you were to look at the market just last week, let's just go. I don't know. Let's go last Thursday for argument's sake, right? And let's go to replay mode. And you could see that just even in replay mode, you were 400 to this is Asia. So let me just go forward. Oh, actually, let me go to Tuesday. You can see how it worked over here. But go into replay mode. No. The point is that the highs and the lows were just a little bit wider, right? Look at the low. There was 300 to like 500 to 200-point ranges too. Overall, you really see the slower volatility in the markets, which to me is a sort of a way to play the ranges. You sell the highs, buy the lows. Now, last Friday we traded live a little bit because we had the opportunity because the price action was sort of trading over the highs and the lows, and I kind of wanted to revisit this little setup with you guys. Let me just go back to current prices, and sort of first of all, I'll show you what we traded in our room today, and I've made this setup imminently easier for people to do. Just sort of very, very logical, very, very simple, easy to do. The way you want to trade by the high, it's just basically intraday fading, right? So we have a trend setup that we do that's worked really, really well, and we have this new fade setup. And the fade setup is basically price hits day session highs. You don't move until you get a red candle. So in this particular case, this is your first short right over here, right? It actually today was it didn't even take us. It took us only one attempt to make money both ways. So you get short over here, 20 stop, 20 target. It goes a little bit against you, and then it just collapses, right? Conversely, and this was interesting because we're trading this fake news, and I was saying to the guys, listen, I don't know if the news is true or not, but we're going to trade price action. And since we have, our stops and targets are determined, we know the risk ahead of time. We're going to just trade through the fog of war. So we were trading this. This was the big dip off the fake news. Actually, I take it back. I think we got. Let me show you. Let me show you this in live price action how this worked out. So.
And for those of you that are on Twitter Spaces, just hit the YouTube link to watch if you want to see Boris's chart and what he's talking about.
And I'm going to take you step by step through the live price action. So we hit fresh session lows, right? And the setup is very simple. I'm going to go candle by candle. We're looking for the first green candle. This candle turns green, and I got long 45, 20 stop. I get instantaneously stopped out because the market is still unsure whether this whole Pentagon story is real, right? Now, we just wait and wait and wait. Don't move until you get a green candle, right? Until you get a green candle. Okay, second green candle over here. This almost takes me to, I remember this trade. This almost took us to profit where 22 target was 41. It went to like 38, then dropped like a stone again. No problem. We take our quick stop at 20 and we just wait. and boom, you get a big green candle. We get long over here, and that's all it took. Boom, 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 boom. Now, if you are more patient and if you are willing to sort of really milk these profits, you had a much more than a 1-to-1 risk reward ratio. Here in this, I was betting 20, lost 20, betting 20, lost 20, betting 20, made 20, in larger size. So obviously my size overcompensated for my things. But if you were betting 20 here, your actual payoff was almost, I think it was 60 to maybe even 80 points higher. Let's just go see how high it went. Yeah, your total. You look. You come in at this price over here at 04. You never again touch it, right? And it goes all the way up to 80. So that was you bet 20 risk, and you make 80 points. 4-to-1 risk reward ratio. So those traders who are looking how to buy bottoms, sell tops with larger risk reward ratios, this is a great setup. You could even do it where I get stopped out once, I get stopped out twice. I go the third time and I make 4 times my money, and your net P&L is much larger.
And Boris, for the listeners, is this something you're trading manually, or is this through the algo? How are you executing this?
So we have tools that can help you trade this. In other words, we have single point and click tools for our members that they can help you trade one trade at a time. So you trade one trade at a time. But to really trade this well, we actually have an algo for my VIP members. That will, in other words, once you instantiate the whole cycle, it will then the next, if it stops out, it will go to the next trade automatically. So it trades for you. It's a lot easier. As a matter of fact, one of the guys in my room just commented. He goes, "I'm so bored with the Surge evaluation because the algo is doing all the trades for me. I'm screwing around with my Thinkorswim account now, buying apples." I'm like, that's the position you should be in.
Right, exactly. Mechanize it, get the emotion out.
You can mechanize it. You definitely take the emotion out. And it's absolutely true. I mean, the emotion is, so this sort of like the last thing I was going to say, as I wanted to share with members, because all the members, and by the way, myself included, always, they have this algo. They want it to trade all the time. They want it to be continuous. They want it to be, they want the market, you want to be in the market all the time. They want the dopamine hits 24 hours a day. We all want the dopamine hits to be 24 hours a day. But I would say, besides trading too large, literally the single biggest sucker, there's 2 sucker bets in the market. One is trading too large, which is like the number 1 sucker bet because you will always get blown out. And number 2, and I'm sure Kay will agree with me because she's actually the queen of not doing this, is trading all the time, being in the market all the time. It doesn't matter how well it's going for you. It will always go badly for you because the market is not designed. Trading is not designed to be continuous. It's designed to be selective. That's the difference between professionals and amateurs. Amateurs want to bet all the time, but the market is only conducive to your setups and only conducive to your risk reward ratios, only conducive to your probabilities at very, very specific times in the market. For us,
can you put a rule of thumb on it? For a beginner, let's say somebody's just starting out, what's a good rule of thumb they should try to shoot for or avoid?
Okay, so it's very dependent on the instrument, right? And very dependent on the asset class you're trading. So for us, the kind of instrument, the kind of strategy we're trading, the absolute best time to trade is the opening of the U.S. Open, the most liquid market, the most liquid time in the world. Maybe the second best time is on the closing hours, but that's it. Those are the best times when you want to participate. You don't want to do this in Asia. You don't want to do this in European Opens. You don't want to do this all the time. And Kathy is very good. Like, for example, for Kathy, when I'm going to speak for her, but she trades FX. So one of the things she adamantly does not do is trade in front of big news events like the NFPs or FOMC or anything else. Because again, it's a sucker bet. I know we all want to be in the market. We all want the price action. And occasionally there are times when Thursday night to Friday morning you get nice movements in pound and yen, and maybe you missed a couple of pips because you didn't trade those. But 9 out of 10 times you actually are going to just get completely pulverized by the news action before the actual true trade manifests itself. And staying away from the market, or just sort of the most important thing is not trading all the time. Not trading all the time is step 1, and then figuring
knowing when not to trade.
Right, and then figuring out when to trade is your second point of view, is much better. But we all have this temptation because my algo can trade 24 hours a day, and I constantly keep telling guys, no, don't do it. It will eventually trip you up. That's why there is no algorithm that makes money all the time. If there was, one guy would own the world, right? So far, smartest guys in the world have never been able to invent a algorithm that trades 24 hours a day. It becomes a money machine. It's always on off. You got to know the market regime in order to be able to to optimize your probabilities. So that was sort of my thought for the day, and that's probably the best advice I can give you as novice traders. Don't overtrade. It's better to do 3 good trades a day than to do 30 mediocre ones.
Sure. And this is stuff you talk about in your live trading room, right? You're not only trading, you're giving these tips of advice, these gems.
And more importantly, in the live trading room, I will show you mathematically why that's a Sisyphean task. For those of you who are familiar with Greek mythology, it basically means why it's a sucker bet in plain English. I'll show you mathematically why trading all the time is really a sucker bet, and why trading selectively is your best chance of success.
I mean, I think that's just important in general, because when you trade all the time and you allow yourself to do that, you get very impulsive. And, that's probably the greatest challenge that, traders have. I did a poll on Twitter about what, people are most frustrated about. And the number one is, being disciplined enough to have the patience. And I think, what Boris said really, encapsulates that, which is, the best way to have patience is to understand what is the best periods of time your strategy works best, or the way you are able to execute it best, and when to just, step aside from the market and, enjoy the nice summer weather.
Sure.
Yeah.
Of course.
Yeah. Get your dopamine hits another way. It's beautiful. It's beautiful outside. Take a walk with a dog. It'll be a lot easier on your psyche and on your account.
Absolutely. Yeah. So, guys, I know there's not a ton of news events this week, but as we wrap up here, if you would just give us the top 3 or 4 again, Kathy.
Certainly. The Fed minutes, number one. I mean, obviously the debt ceiling's in the backdrop, but the Fed minutes are number one. Eurozone PMIs, and it's either going to be the PCE deflated from the U.S., or if you care about everything else, the Reserve Bank of New Zealand rate decision.
Got it. Perfect. And before we go, Boris, since you're still up, would you pull up gold and oil for us? Give us your weekly take. We've been getting a lot of good feedback from your calls. They love it.
They love my calls. So it's funny today. I tweeted out today that everybody on Fin Twitter loved it. I said gold is the New York Mets of financial assets. And it was just sort of an inside joke. If you guys don't know, that Stevie Cohen, who is probably one of the greatest traders of all time, and one of the legend hedge fund managers, has made more money than anybody in the world, right? Has not been defeated by the markets, has never been defeated by the SEC, which investigated him, has never been defeated by anybody. But then he bought the New York Mets, and it looks like he's going to be defeated. His fortune is going to be defeated by the New York Mets. And to me, gold is sort of very similar in that sense, that it always disappoints. And, we talked about last week how I said gold is not a buy until we cross 21. And more importantly, I was saying to people that, gold may actually be a sell if we cross 1950. So let me actually just get a little bit. This is a 4-hour chart, and I had that. This was the initial support level, right? This is 1975, and we're just consolidating here. We're really not rallying up, going higher. I think part of it is, as Kathy was saying, yields are up. I mean, yields are up significantly. We're at 3.72 on the yield. Yields are up, obviously, I think because of uncertainty over the budget. If they do come to some kind of a deal, probably we'll get a little bit of a relief in the yields. Maybe that's going to be a bounce to gold, but we have to watch it. Overall, if you're looking at gold right now, the chart tells you distribution. It does not tell you accumulation. This was you should have been buying gold here, maybe even buying gold here on the third dip. Right now, gold is more a sell than it is it's definitely not a buy, but it's tipping over into being a sell. You have this huge distributive top over the month. You barely have it, jumping off this 1950 support level. And to me, if it kind of just, turns back down and breaks the 1950, there's just nothing here. It's just air until 1800. And God knows that would be sort of the ultimate irony, where everybody thought, oh, this was the one time gold is really going to break out, and it's going to break once it breaks the hearts of the bulls below here. I think it's just going to trigger a cascade of stops. So technically, I think you have to be very, very wary of gold. Oil, on the other hand, much better story. And we talked about this. The oil is a series of higher lows right over here. Let me just get my little arrows. Series of higher lows, right? And remains. I mean, it just holds the high. So long as the lows remain high, you got to believe that. There is a couple of. I heard there was a couple of hedge fund bets, uber bearish bets. I'm like $50 oil, and it was actually essentially a bet on a global depression. So yeah, if I'm 100% wrong and there's a global depression, oil is definitely a sell. But to me, first of all, the chart isn't telling me it's a sell. The chart is telling me it's a beautifully accumulation buy, and that it could be a move towards the 70s, at least 75s, possibly all the way up to the 78s, as growth picks up and global demand picks up. So I have a dichotomy of gold versus oil. This is actually sort of a interesting idea: long oil, short gold as a pairs trade. It could definitely. I warn people that when you're trying to do pairs trades, sometimes you get clever by a half, and it can be completely go the other way around.
Right.
Right now, this is definitely the better trade to make as you're looking at the two things. The other thing I was going to say is, I don't know if you guys. I fooled around with crypto over the weekend. I was just testing my algo just to see, but crypto is just also dying. Like I don't really, I stopped following it, but. Technically, look at this. Everybody got it. Crypto is sort of like looking like the new gold in a sense. It gets everybody's hopes up over here, and then just starts making lower highs. It kind of just dies out here on a 4-hour chart, maybe even let's go on a daily chart. It's definitely looks like it just made a peak high here, and that's the interesting part here in crypto will be this whole 25,000 level, because it's a big psychological level. And once those levels get broken, you could just have a massive distributive move down. And I think that's what's interesting is if you do get this massive distributive move down, why this will be particularly negative for crypto is because, remember, the whole story with crypto was every new rally makes a fresh high, right? And if this was indeed, the big rally wave, and it didn't even come close, it died 50% towards the new high, maybe the story is over.
Right. Interesting.
So it'll be worth watching.
So we have a couple.
Kathy, you mentioned there's some questions.
Yeah, we have a couple of questions. The first, they're all different types of questions. One of them was in regards to what we're expecting from the Fed minutes. So for those of you that were joining us late, in regards to the Fed minutes, the last time the Fed met, they set the stage for a pause. So the Fed minutes are expected to be less hawkish, but data hasn't been terrible, and so there's definitely still, and there's a lot of debate within the Fed itself. So there is still scope for some dollar positive or hawkishness in the minutes themselves. So it's really a coin toss, but I think it will probably reaffirm what Powell has been saying, which is that they're at the end of their tightening cycle. We have another question, and I guess this question comes up a lot, Corey, which is, what platform do you get your news from? And,
it sure does.
People ask us this week after week, and I guess maybe I should just do a YouTube video with this, but I'll share my tweet deck again. If you can share, if the producer can put it up. But TweetDeck, if you're a trader, you really should have TweetDeck, because that allows you to aggregate news feeds, allows you to aggregate your thoughts. My personal favorite are Forex Live, News Squawk, Investing.com. Then you can add in, Reuters, Bloomberg, Wall Street Journal, or something like that. I personally like Zero Hedge. Boris always makes fun of me, but that's I think everything you need is probably going to be in these feeds. Last week I showed you that I liked I have him in my aggregate feed. I think it was like Vishal Patel. Let me see if I can get Twitter.com. I think it was Vishal V Patel FX. So I like him a lot too. Less for news, but more for analysis. And these days, pretty much everything that every release that is expected to be released will come out, within seconds, like within seconds to milliseconds on Twitter, either on Forex Live, News Squawk, or one of the major feeds like Reuters, Bloomberg, or something like that. So set your tweet deck up when you've got numbers coming out. Look for it there.
And guys, there's 100 YouTube tutorials on there. Just go to TweetDeck, how to set up, and you'll figure it all out. In the beginning, it took 15 or 20 minutes, but I set it up. It's super useful. I've been using it for the past month, and I just love it.
Great.
I think you gave Kathy an idea for a new YouTube video.
I know it did, but then I have to go back and figure out how I did this like 10 years ago. Which I'm not sure what I'm going to do.
Me too. I have a time I'm like, I got to remember how I actually did this. That's the hard part. Yeah.
There's a comment on NASDAQ making a beautiful M formation. I don't know if you want to pull that up, Boris.
Sure.
You
got the screen. This is on what on a daily? Is that what he's looking for? It's not an M, it's a W. If he's looking on a daily. Are you guys seeing my screen?
Yep,
yeah,
I see it now.
That's if we're looking at a daily, which is I am, that's actually a W formation. And that's also very, very bullish. So you see low, test, retest, hold, breaking out. We're actually breaking out. We broke out this candle over here. And I said, NAS above 30, NAS holding above 13,000. Very, very bullish. Very bullish. I'm a believer in making this stuff very simple. Can price hold above key round numbers? Doesn't have to be fib numbers. By the way, I tweeted out is 14 a fib number? Because I thought that was funny. People like that for a second. It's a reference to 14th Amendment. Fib 14 is not a fib number. It's just a play on the fact that fib numbers are numbers like any other numbers. And by the way, those of you who are like all into the whole idea that Fibonacci repeats itself in nature, just a fun fact. There are more species that don't follow the Fibonacci sequence in nature than there are species that do follow the Fibonacci sequence. So just like everything else, it's a 50-50 proposition. Don't get too hung up on it. But keeping stuff simple, if things hold above key levels, and that's the key thing, hold, it's naturally bullish fact. Because what it means
when you say hold, give us a quantifier there. One day, a week, a month.
A week is better than a day, and a month is better than a week, right? It's the point is that there isn't a definitive number. It depends on what time frame you're looking at. But if you're looking on a daily time frame, if you got 5-6 days of holding that position, that's a good indicator that maybe in the next couple of weeks we're going to go higher. If you're looking on a monthly time frame, it's much longer. If you're looking at a minute time frame, then you don't care. You're
right
with other levels. But I think generally, if those who are trading the daily, we've already had 2 or 3 days. We're holding above the this key breakout level over here, right? And more importantly, just sort of like here's the 13,000 level. Which is it's far away. It's it is a couple of percent away. But basically, my point is that we broke out through all of this resist over here, and all against very, very, very bearish Everybody is convinced that it was the worst economy ever, and we're going into the 1929 depression. And the more everybody's convinced of that, the more people keep talking about that, the more University of Michigan survey sentiment literally prints lower than the 9/11 and the 87 crash, the more positive it is for equities. It just means that the economy is going to be booming. So to me, when price is confirming the overall thesis, you really want to be looking at this price over here. So yes, it's bullish on NASDAQ. Doesn't mean it can't change. It doesn't mean we could have big dips. But for now, absolutely the path of least resistance is to the upside. And you want to be trading that.
So our listener was actually looking at the 15-minute chart, which obviously is a very short time frame, but maybe you can look at that and see what he's talking about.
Okay. Well, now I have to. Sorry, I have to get bigger. I know why. Because my whole. The problem is, hang on a second. Auto fit. Okay, here we go. 15-minute chart. So you're talking about here, sort of the W here. What
was
can
the
you?
M. It was an M, not a W.
Yeah, I don't even see the M. I don't know where he sees the M pattern.
If you don't, it's fine. If you don't see it, then
Honestly, but what I will say this is, don't die on the 15-minute hill. Don't die on the 1 minute. The point is, the shorter the time frame, the more noise there is on it. I trade the 1 minute time frame. It's all noise. That's why the only thing I trade on the 1 minute time frame is the highs and the lows, which are absolute and definitive. Any pattern on a shorter time frame is noisy because there is a million other factors that are moving price on that time frame. So it's fine. Don't get me wrong. It's totally tradable as long as you take it with a barrel of salt and understand that it's going to be a 50-50 proposition whatever you do. That's why, by the way,
Sure.
when we trade, this is another thing that's interesting is when we're trading on a very short-term time frame, we never ever assume our trade is going to win, right? That's why we give ourselves 6 chances to lose, precisely because we know that there is so much noise on a shorter term time frame that the probability of anything being even 25% accurate, much less 50% accurate, much less 75% accurate, is literally zero. So you have to multiply your 1.5 times 1.5 times 1.5 times 1.5 becomes like 95% accurate when you flip it over. That's just the basic mathematics of probability. That's the only way you can achieve consistency on a shorter term time frame. At least that's the only way I know. So I'll leave you with that thought. You want more? Join Surge, come into my room, and we'll show you high probability trading. Or you can join Surge, come into Kathy's room, and she'll show you some high probability trading too.
Absolutely. And anybody who takes an audition with us gets 30 days free from BK Trading, BK Forex. You guys can join them in the room and learn this stuff live every day. Right.
Exactly. But anyways, don't
Awesome.
overtrade. That's my mantra for the day. Don't overtrade. It's choppy markets as is. Until we get some clarity, you might as well just take few and far between shots here.
Great.
Absolutely.
Okay, so we're looking for the PCE this week.
Yes, looking for the PCE. Exactly.
Awesome. Well, thank you guys so much. Hope you have a great day, great trading week, and we'll chat shortly.
You will do. Thanks, Corey.